to part 2 of our budgeting for non-finance people. In part 1, I talked to you about why we have budgets. I talked to you about how budgets help you to implement your business strategy. And I also emphasized the fact that when people talked about the budget, what they're really usually referring to is the profit and loss account budget, because that's the key budget within an organization. I also gave you some terminology relating to cost behaviors. So we talked about variable costs, fixed costs, and semi-variable or stepped costs. Now in part 2, I'm going to have a look at the actual preparation of the global budgets of an organization. So I'm going to take a step-by-step approach to that, starting with the construction of the profit and loss account budget. Then I'm going to go and show you an example that I've created, which looks like many real budgets do in practice. In other words, it's presented in a spreadsheet format. Not beautiful to look at if you're not an accountant. Accountants love them. Non-accountants tend not to like large spreadsheets, but at least you'll have been exposed to something that looks like a real budget does in practice. Then I'm going to move on and talk about your role as a manager or business owner and the different roles that you could have depending on your level of experience or level of hierarchy that you're at within an organization. And then I want to finish off with something that links to that last thing about the manager's role, the idea that budgets are generally in practice created from the bottom upwards, and that leads to problems sometimes in that you will, as a manager, you'll make your budget submissions, you'll think you've finished your work, and then you'll be asked to resubmit your figures, and that can be very frustrating. And I've put the last bit in to help you see why that process is taking place, and that hopefully will make it less frustrating for you if it does happen in practice. And then at the end of part 2, we'll finish off with a couple of multiple choice questions so you can test your understanding of the subject. So let's get on and have a look at budget preparation. So when you start to put together your budgets, the first thing you need to start with is what's known as your critical budget factor. There will usually be one factor that will drive everything else. And the critical budget factor is usually your income. What income are you going to get? Whether you're in the private sector, whether you're in the public sector, you will normally start with your income. So basically, you're going to start by preparing your profit and loss account budget. That's the critical budget that everybody's interested in anyway. And that's where you start, because the level of profit you're going to make will drive everything else. It will dictate to you how much you can spend on new assets. It will dictate to you whether you need to go to the bank to borrow more money. So you start with the P&L and you start with the income. So we need to start by working out what our income budget is, how much we're going to earn from our customers. We'll have to look at the markets we operate in. We'll have to look at what's happening to prices in those markets. We'll have to look at whether or not we're intending to open up new units of our business in different locations. We'll have to look at all sorts of things, but we come up with that income budget. That's our start point. And in an ideal world, we will come up with that first. Right? That's in an ideal world. Won't always happen like that in practice, but that's the thing that drives everything else. Now, once we know that, we can then start to look at our costs in that P&L. So we're just doing the P&L at this stage. We've got our income, and now we need to look at our costs. So we always split costs into two, don't we? We've got our direct costs, first of all. Now, direct costs, if you're not sure, we do cover this in our General Finance for Non-Finance Managers series. But if you're not sure, just in brief, a direct cost is any cost directly associated with what you are selling to your customer, whether it's a service or a product. So if I go back to the coffee shop example, the direct cost will be things like the milk, the coffee, the sandwiches, the wages of people making the coffee and the sandwiches. Those will be the direct costs. Now, most of the direct costs, I'll put them up on the screen: labor, the cost of wages of the people making the coffee, the materials, and so on. Most of those direct costs will be variable costs. So link back to the terminology we did on the part 1. Yeah, but there will also be some semi-variable costs in there, some stepped costs, if you like. So the wages of the barista making the coffee, those will be stepped. The barista might be able to make 100 cups of coffee a day, but once it goes up to 150, you need a second barista. Yeah. There will also be some fixed costs in there as well, because, for example, the depreciation on the coffee making machine, that will be an even amount throughout the year. So it will be a mixture, but the predominant cost type will be variable in your direct costs. Once we've got our direct cost budget, we can also prepare our overheads budget. This is a lot easier to do because a lot of the overheads, like the selling costs, the admin cost, the cost of paying your accountant, for example, often the cost of rent and the cost of business rates. A lot of these costs will be fixed. So in the overheads or indirect cost section, it will be sort of the other way around. There'll be more fixed costs. There will also be some stepped costs as well. You'll have staff in your sales team, and if your sales shoot up dramatically, you might need to employ extra members of staff. You'll also have variable costs in there because things like stationery will vary depending on how many customers you've got, but the majority of costs will be fixed. And actually that makes it much easier for the accountant to budget for, because the accountant will be able to go to the local authority and get the rates bill, the business rates, and they'll be able to see what they are. They'll know what the rents are on the premises. So it's quite easy for the finance team to budget for those fixed costs, but it's which are mainly in the overheads. But it's more difficult to try and budget for those direct costs when the accountant will need more help from the people who are working in the business. That's you, the managers. Okay, once we've got all that information, then we can put together our profit and loss account budget. Remember, I've just put it in there that the profit and loss account has another name that's sometimes used, which is the income statement. Income statement, profit and loss account mean the same thing. So our profit and loss account budget comes first. Now, once we've got that, once we know how much profit we're going to be making, and when we're going to be making that profit, then we can put together the second most important budget, the cash budget. Cash budget is really important, particularly to the finance team. The finance team will keep a close eye on the cash budget, because looking at that cash budget can help them decide whether they might need to go for extra funding, whether they might, for example, need to go to the bank and ask for an overdraft in, let's say, April when the cash gets low, or whether they need to go for a longer term bank loan. And when we've got the cash budget together, we can also put together another very important budget, which is called the capital expenditure budget. Now, capital expenditure, sometimes abbreviated to CapEx, C-A-P-E-X, capital expenditure or CapEx, that's the budget for buying new, large, long-term assets. So in our coffee shop example, the sort of capital expenditure we might be making might be new tables and chairs, a new cappuccino making machine. That would be capital expenditure. Yeah. So we'll put together a special budget for capital expenditure. And once we start talking about that, we have to start thinking, well, hang on, if the profit and loss account budget comes first, and that then determines how much cash we're going to have, and we then need to think about whether we want to spend any money on assets, then there might need to be a little bit of rejigging of the budgets at this stage. Why? Well, because the profit and loss account budget might not be creating enough cash in the cash flow budget for us to be able to afford to go and get the capital expenditure. So the accountant team are going to have to start thinking, well, hang on, have we got enough cash? Do we need to go and borrow some money from the bank and so on? So sometimes budgets can go through several different versions as we start pulling things together. We might have to go and revisit things. And if you're a manager, it's worth knowing that, because that can be quite frustrating for you. Once we've got to the end of this, we could then, if we want to put together a budgeted balance sheet. I know that not all organizations do this. It's not a particularly important document. It just shows you where you're going to be at the end of your budget period. And putting it all together, that would be called our master budget. So our budget is really, in summary, driven from that critical budget factor that decides the output, which is how much income are we going to have. And we then filter that down, create our profit and loss budget. Once we've got that, we can then create the subsidiary budgets, the cash budget, the capital expenditure budget. And then if we want to, we can put together a balance sheet budget. So the critical thing is the P&L budget. It's the P&L budget. As I said before, when people talk about the budget, they're usually talking about the P&L budget. And certainly as a manager, that is the budget that you will see. As a manager, you're unlikely to see the cash budget because it's the finance team who will control the cash within the organization. It's the finance team who will take action if we need to get extra borrowing and so on. What we want the managers to be concerned with is running the day-to-day operations and making sure they meet their profit targets. Okay, so that's the overview. That's the step-by-step approach that you'd take in an ideal world. I want to go and have a look at an example now of an actual budget, an actual profit and loss account budget, which is the one you're more likely to see as a manager. So let's do it.